Welcome to today's video, where we're going to delve into one of the most important aspects of successful investing, the psychology of investing. Investing isn't just about numbers, ratios, or technical indicators. It's also about controlling your emotions and staying disciplined during times of market volatility. Today, we'll focus on how greed and fear can dramatically influence our decision-making and how we can learn to master our emotions to become more successful, long-term investors. This is a core concept that Benjamin Graham, the father of value investing, emphasized time and again: why emotions matter in investing. Emotions like greed and fear can cause investors to make irrational decisions. When the market is soaring, greed can push investors to take on more risk than they should, chasing higher returns without regard for risk. Conversely, when the market drops, fear can lead investors to panic sell, locking in losses rather than waiting for the market to recover. The key to successful investing is not just picking the right stocks, it's about being able to control your emotions. Avoid impulsive decisions and stick to your strategy no matter what the market is doing. Graham understood that investing is as much psychological as it is financial, understanding the role of emotions in investing. Psychology of fear and greed. Fear and greed are the two dominant emotions that drive most market behavior. Let's first look at fear. When the market is down, fear can overwhelm us, leading us to sell off assets at a loss or avoid investing altogether. This behavior often stems from the fear of losing money or the fear that the market will continue to decline. On the other hand, greed arises when the market is up and prices are rising. Investors can get caught up in the excitement of rapid gains, believing that prices will continue to go up indefinitely. This often leads to overconfidence and investing in speculative assets that aren't backed by strong fundamentals. Emotional investing and market cycles. During bull markets, greed drives up asset prices beyond their intrinsic value, and in bear markets, fear causes prices to fall below their intrinsic value. These market cycles are largely influenced by investor psychology, and understanding this dynamic is essential for maintaining a rational approach. Graham's view on emotional investing. Benjamin Graham was acutely aware of the psychological challenges investors face. He often spoke about the dangers of allowing emotions to dictate your investment decisions. He believed that rational thought and discipline should guide all decisions, rather than the emotional impulses that come with market fluctuations. One of his key lessons was to separate yourself from the market's moods, whether bullish or bearish, and focus on the intrinsic value of the asset you're investing in. Graham believed that long-term investors should use market volatility to their advantage, not succumb to it. In his book, The Intelligent Investor, Graham outlines how investors can control their emotions by sticking to a well-defined investment plan, even when faced with fear or greed. He believed that emotional stability is one of the most important traits of a successful investor. Behavioral finance, the science of investor psychology. Behavioral finance is a field of study that examines how psychological factors influence investors' decisions. It helps explain why investors often behave irrationally, even in the face of objective facts. For instance, loss aversion is a concept from behavioral finance that explains why people feel the pain of losses more intensely than the pleasure of gains. This can lead investors to hold on to losing positions for too long, hoping they'll recover, instead of cutting their losses. Other biases include confirmation bias, seeking information that supports your beliefs, and herding behavior, following the crowd without due diligence. All these biases distort rational decision-making and can cause investors to act impulsively. Identifying emotional pitfalls in investing. Dangers of greed. Greed can manifest in many ways. When markets are rising, greed pushes investors to chase after high-flying stocks, often without understanding their true value or the risks involved. This is where the danger of speculative bubbles arises. Investors start believing that the market will only go up, and prices become disconnected from the underlying fundamentals. The dot-com bubble, the housing bubble of 2008, and the crypto boom are all examples of markets driven by excessive greed. Signs of greed. Investors should be wary if they find themselves making decisions based purely on fear of missing out, FOMO, or chasing high returns without considering the long-term implications. The dangers of fear. Fear is equally dangerous. When the market starts to drop, fear can lead investors to sell off their investments in a panic, often locking in realized losses. Fear causes us to act impulsively, often at the worst possible times, such as selling during a market downturn when prices are actually undervalued, market cycles, and fear. When the market is going down, people often think that it will never recover, but history has shown that markets tend to rebound over time. Investors who hold their positions and stay calm through bear markets are usually the ones who benefit the most. Signs of fear. If you find yourself constantly worried about short-term market movements, or if you're tempted to make hasty decisions based on fear, it's a sign that your emotions may be driving your investment strategy. Confirmation bias and herd mentality. Another emotional pitfall is confirmation bias, where investors seek out information that confirms their preconceived notions or beliefs, ignoring information that contradicts them. This often happens when investors latch onto positive news about stocks they've already invested in, ignoring negative news or failing to conduct proper research. Herd mentality is another pitfall where investors follow the crowd without doing their own research. This often happens during market bubbles when everyone jumps on the bandwagon, leading to overinflated asset prices. Managing your emotions as an investor. Developing emotional discipline. The key to controlling your emotions as an investor is discipline. You need to have a clear, rational investment plan and stick to it, no matter how volatile the market may be. One way to develop emotional discipline is to focus on long-term goals. When you're invested in the long-term health of a company or asset, the daily fluctuations of the market don't affect you as much. Creating a strategy and sticking to it. Write down your investment goals, risk tolerance, and strategy, and use this as a guide to make decisions. When the market gets turbulent, go back to your plan and remind yourself of your long-term objectives, focusing on fundamentals, not market noise during times of volatility. It's essential to stay focused on the fundamentals of your investments, rather than reacting to daily market swings or news headlines. Keep your eyes on the underlying value of the companies you've invested in. Graham's margin of safety. One of Graham's principles, the margin of safety, helps manage emotional responses. By purchasing assets at a significant discount to their intrinsic value, you have more room for error if market conditions don't go as planned. Managing losses and staying rational. Managing losses is one of the hardest aspects of investing. When you face a loss, it's easy to let emotions like regret, frustration, or fear take over. However, successful investors don't react emotionally to losses. Instead, they assess whether the underlying investment still aligns with their long-term strategy. Cutting losses. Graham emphasized the importance of cutting your losses early, rather than letting them drag on. This means being able to admit when an investment isn't working out and making adjustments accordingly. Techniques to control your emotions. Mindfulness and emotional awareness. Practicing mindfulness can help you become more aware of your emotional triggers. By noticing when you feel fear or greed creeping in, you can make more informed, rational decisions. Mindfulness techniques, such as deep breathing or journaling about your investment decisions, can help you stay grounded and focused on your long-term goals. Setting investment guidelines and boundaries. Having clear investment guidelines and boundaries is essential for controlling your emotions. Set rules for when to buy, sell, and hold investments, and stick to them regardless of market conditions. Establish limits for how much risk you're willing to take and know when to exit an investment if it no longer fits your strategy. Seeking support and staying educated. Sometimes it helps to talk to other investors or professionals who can provide objective advice when emotions run high. Seeking support can give you perspective and prevent you from making hasty decisions. Additionally, staying educated about market trends and understanding the fundamentals of your investments helps you stay rational when emotions want to take over. Real-world examples and case studies. Case Study 1. The dot-com bubble and investor psychology. The dot-com bubble is a classic example of greed-driven investing. Investors were so caught up in the excitement of the internet revolution that they ignored the fundamentals of many tech companies, leading to a massive market crash. Graham's principles would have warned investors to stay grounded and avoid speculative stocks during this period of irrational exuberance.